Dude, I owe you big time. That's a text message between two bankers at the world's most powerful financial institutions. It sounds like nothing, but that one message helped unravel the biggest financial fraud in human history. We're talking about a number, one single interest rate. It didn't have a flashy name. It wasn't a crypto token or a startup pitch. It was called LIBOR, and it quietly sat underneath $350 trillion in financial contracts. Your mortgage rate, your student loan, your city's pension fund, all of it tied to this one number. And for over a decade, the bankers who said it every morning were lying. Not by accident, not by a rounding error. They were texting each other favors over Bloomberg chat like they were ordering lunch. Tonight, we're going inside the most brazen financial manipulation the world has ever seen. We'll follow the trader who turned it into a personal ATM. We'll expose the banks that knew and said nothing. And we'll answer the question that still haunts regulators today. How do you rig a number that runs the entire global economy and get away with it for 30 years? To understand how this happened, we need to go back to 1986. London, the financial capital of the world. The Cold War is winding down. Reagan and Thatcher are deregulating everything in sight, and the global banking industry is exploding in size. Banks are suddenly lending money across borders at a scale never seen before. American banks lending to Japanese firms. British banks financing deals in Singapore. But there's a problem. Every country has its own interest rate. There's no single benchmark that banks worldwide can agree on. So the British Bankers Association invents one. They call it the London Interbank Offered Rate, LIBOR. Every morning, a panel of the world's biggest banks submits a number. That number represents one thing. What rate would you pay to borrow money today? The BBA takes those submissions, strips out the highest and lowest, and averages the rest. That average becomes LIBOR. Simple, clean, trusted. Within years, LIBOR isn't just a benchmark. It's the foundation of the entire global financial system. Mortgages, corporate loans, derivatives, student debt. By the 1990s, every major bank on Wall Street is building products on top of it. If LIBOR moves 1 basis point, that's 1/100th of 1%. The impact runs into billions. Now meet the people submitting those numbers. They aren't regulators. They aren't independent economists. They're traders, sitting inside the same banks that have billions of dollars riding on where LIBOR lands. Let that sink in. The people setting the world's most important interest rate have a direct financial incentive to set it wrong. And in the beginning, most of them don't even think about it. The system is built on a gentleman's agreement. Submit your honest number, trust the process. For a while it works. But then comes Tom Hayes. Hayes joined UBS in Tokyo in 2006. He's 26 years old, brilliant at mathematics, and obsessive in a way that unnerves his colleagues. He doesn't drink at client dinners. He doesn't do small talk. He does derivatives. Specifically, he trades instruments called interest rate swaps, contracts that pay out based on where LIBOR lands. Hayes isn't the first trader to notice that LIBOR submissions can be nudged, but he is the first to turn it into a system. He builds a network. Traders at other banks, brokers who relay messages between institutions, even submitters inside his own bank's treasury department. His Bloomberg messages are almost comically direct. If you could see your way to moving it a little lower today, I'd really appreciate it. And it works. When LIBOR moves the way Hayes needs it to move, his trading positions print money. By 2007, Hayes is generating tens of millions of dollars a year for UBS. His bosses aren't asking questions. In banking, nobody asks questions when you're making money. The offices are gleaming. The bonuses are real. And the fraud is invisible, buried inside a number that almost nobody understands. But in 2007, one compliance officer at Barclays writes a memo. The memo says the system is broken. He flags it internally. He is ignored. We'll come back to that memo, because that ignored warning is the thread that eventually unravels everything. Okay, let's talk about how this actually worked, because the mechanics of this fraud are genuinely elegant, and understanding them will make you furious. LIBOR is set every morning at 11 a.m. London time. Each panel bank submits a number by 11:10. That number is supposed to reflect reality. What rate would your bank actually pay to borrow cash today? But here's the thing. In most cases, banks aren't actually borrowing at that rate. It's a hypothetical, an estimate, which means there's no transaction to verify it against. No receipt, no paper trail, just a number typed into a spreadsheet by a human being. Now imagine you're Tom Hayes. You're holding a derivatives position worth $300 million. If LIBOR closes even 1 basis point lower than expected, you make $300,000. One phone call to a broker, one Bloomberg message to a contact at another bank. Can you nudge your submission down just a touch today? And suddenly, that hypothetical number moves, and $300,000 lands in your column. This isn't a heist with masks and getaway cars. This is a text message before breakfast. Hayes runs this play dozens of times a week. He has contacts at RBS, Deutsche Bank, Citigroup, and JP Morgan. Brokers who act as middlemen, collecting requests, relaying them, earning their cut. The network spans 3 continents and at least 12 institutions, and nobody thinks of it as fraud. They call it helping each other out. Now let's talk about who's paying for all this help. Every time LIBOR is nudged lower than it should be, someone on the other side of those contracts loses money. Not a hedge fund, not another bank. Ordinary people. The city of Baltimore, Maryland had financial contracts tied to LIBOR. When banks artificially pushed the rate down during the financial crisis, Baltimore lost an estimated $550 million in expected payments. $550 million. That's police salaries, school budgets, road repairs. Gone. Across America, municipalities and local governments lost a combined $6 billion. Pension funds, the retirement savings of teachers, firefighters, and nurses, were hit even harder. These funds held interest rate swaps that paid out based on LIBOR. When banks move the number, those payouts shrink. Retirees didn't get what they were owed, and they had no idea why. Meanwhile, Hayes is pulling in $70 million in profits for UBS in a single year. His bonus alone is $2.4 million. He buys a house in Surrey. He drives a Porsche. He's 28 years old, and the machine is running perfectly. But Hayes isn't the only one. While he's building his network in Tokyo, the culture of LIBOR manipulation is spreading through every major trading floor in London and New York. At Barclays, traders are emailing rate submitters directly. The emails read like a takeout order. Prefer a low 3-month fix today. Would love a high 6-month if possible. The submitters comply. Sometimes they add a smiley face. A smiley face on an email manipulating a rate that controls trillions of dollars. At Deutsche Bank, the manipulation is so routine that one trader keeps a spreadsheet, a literal log of every time he moved the rate, every request, every response, every profit. He saves it on a company server. We'll come back to that spreadsheet because it becomes Exhibit A in one of the largest criminal investigations in financial history. By 2008, LIBOR manipulation is institutional. It's not rogue traders acting alone. It's a system baked into the daily rhythm of the world's most powerful banks. And then the financial crisis hits. Banks are terrified. If their LIBOR submissions look too high, markets will assume they're in trouble. So they submit low numbers. Not to profit from derivatives this time, to hide the fact that they're dying. And here's where the story gets even darker. Because someone at the very top of the British financial establishment knew, and instead of stopping it, they may have encouraged it. Now, everything I've told you so far is bad. But what I'm about to show you next is so brazen, even I couldn't believe it when I read it. In October 2008, at the peak of the financial crisis, a phone call takes place. On one end, Bob Diamond, the CEO of Barclays. On the other end, a senior official at the Bank of England. The Bank of England. the oldest and most powerful central bank in the world. According to Barclays' own internal memo, that official suggested the bank's LIBOR submissions were too high. And within 24 hours, Barclays dropped their submission. The central bank, the institution designed to protect the financial system, had just nudged the world's most important interest rate. The question that haunted investigators for years: was this a suggestion, or was it an order? It starts with a newspaper. May 2008. The Wall Street Journal publishes a story with a deceptively simple question: are major banks lying about their borrowing costs? The reporters had noticed something strange. During the financial crisis, banks were submitting LIBOR numbers that looked too clean, too calm. While credit markets were in open panic, LIBOR barely moved. That's statistically impossible, unless the numbers aren't real. The story doesn't cause an immediate earthquake. Banks deny everything. Regulators shrug. But inside the DOJ, the CFTC, and the UK's Financial Services Authority, a small group of investigators starts pulling threads. And what they find is not subtle. The emails are still on the servers. The Bloomberg messages are still archived. The spreadsheets are still sitting on company drives. Nobody deleted anything, because nobody believed they'd ever get caught. That arrogance is the first domino. Investigators subpoena records from Barclays, UBS, Deutsche Bank, and RBS simultaneously. What comes back is staggering. Thousands of emails, hundreds of Bloomberg messages, a decade of documented requests between traders and submitters at multiple institutions. One UBS email chain alone runs to 400 pages. At one point, a trader writes, "And I need you to hear this clearly. We are making fortunes based on this." Fortunes based on lying, written down in a company email. Now the investigators have everything they need. But prosecuting a fraud this size across multiple countries and jurisdictions is a different problem entirely. The DOJ needs someone to break first. In June 2012, Barclays breaks. The bank agrees to pay $453 million in fines. In exchange, it hands prosecutors a complete roadmap: names, dates, transaction records, the internal memo about that Bank of England phone call, all of it. Within weeks, CEO Bob Diamond resigns. Barclays chairman Marcus Aegis resigns. The British Parliament launches its own investigation, and the global media finally catches up to what investigators have known for years. LIBOR was rigged by everyone for decades. Now the dominoes fall fast. UBS pays $1.5 billion. RBS pays $612 million. Deutsche Bank pays $2.5 billion, the largest fine in CFTC history. Citigroup, JP Morgan, HSBC, one by one, every major bank in the world settles. The combined total eventually exceeds $9 billion. $9 billion in fines. And almost nobody goes to prison. Almost. Because investigators still want individuals. And one name keeps appearing in every document trail: Tom Hayes. By 2012, Hayes has left UBS under a cloud. He briefly joined Citigroup, where he ran the same playbook, then got fired when the investigation started heating up. He's now living quietly in Surrey with his wife and infant son. On December 11, 2012, his front door comes off the hinges at 7 a.m. The Serious Fraud Office sends 12 officers. Hayes is arrested in his bathrobe. He sits in an interview room for 82 hours over 10 days, and he talks. He talks about everything. He names every contact in his network, every broker who relayed his requests, every submitter who moved the number. He believes, genuinely believes, that cooperation will protect him, that if he explains how the whole system worked, prosecutors will understand he wasn't alone. He is catastrophically wrong. In 2015, Tom Hayes stands trial at Southwark Crown Court. The prosecution case is built almost entirely from his own words: his Bloomberg messages, his recorded phone calls, his 82-hour interview. That Deutsche Bank spreadsheets Exhibit A is projected on a courtroom screen. Every request, every response, every profit. His own meticulous records convict him. The jury deliberates for less than 2 days. Guilty on all 8 counts. The judge delivers the sentence without hesitation. 14 years. Hayes sits perfectly still when he hears it. His wife collapses in the gallery. Outside the courtroom, his lawyer reads a statement. Hayes maintains he was doing what his managers knew about and encouraged, that the system was rotten from the top, that he is a scapegoat for an industry-wide crime. Here's the brutal irony. He's not entirely wrong. Tom Hayes served 5.5 years. His sentence was reduced on appeal in 2015. The court accepted that his role, while criminal, existed inside a system of institutional failure. He walked out of Flotham Grange Prison in 2021. He has spent every day since campaigning to clear his name. In 2024, a UK appeals court quashed the convictions of several other LIBOR traders. The judges ruled that the jury instructions in those trials had been flawed. Hayes immediately filed a new appeal. As of today, his legal fight continues. Now let's talk about the executives, the people above Hayes. The managers who saw the profits, asked no questions, and collected their bonuses. Not one senior banking executive was convicted in the United States. 1. The DOJ prosecuted 16 individuals in total. Most were mid-level traders and brokers. The people who designed the culture that made this possible walked away clean. Bob Diamond, the Barclays CEO who resigned in disgrace, went on to found a new investment firm in Africa. He is worth an estimated $100 million today. Now let's talk about the victims, because this is the part that gets left out of most coverage. The city of Philadelphia lost $331 million on interest rate swap contracts tied to LIBOR. Detroit, already on the edge of bankruptcy, lost hundreds of millions more. In California, the Los Angeles School District paid $51 million in fees on derivatives contracts that only existed because LIBOR was artificially depressed. $51 million. That's textbooks, teachers, school buses, extracted from children's education by bankers sending smiley face emails. Homeowners were hit differently, but just as hard. During the financial crisis, banks suppressed LIBOR to hide their own distress. That sounds like it should have helped borrowers. Lower rates mean lower payments. But the suppression also destroyed the credibility of every contract built on LIBOR. Billions in expected payments never arrived. Trusts, funds, and institutions that were owed money based on LIBOR rising simply didn't get paid. And they had no legal recourse because LIBOR was privately administered. Nobody owned it. Nobody was legally responsible for its accuracy. That's the regulatory hole that made this entire fraud possible. After the scandal, global regulators scrambled to fix it. The Financial Stability Board launched a worldwide effort to replace LIBOR with rates based on actual transactions. Rates that couldn't be faked because they reflected real trades. In the United States, the replacement is called SOF, the Secured Overnight Financing Rate. In the UK, it's SONIA. On December 31, 2021, LIBOR was officially retired after 35 years. The benchmark that once underpinned $350 trillion in contracts simply ceased to exist. But here's what didn't change. The banks that paid $9 billion in fines absorbed those costs without structural consequence. The fines were treated as a business expense. Shareholders lost money. Customers absorbed fee increases. The executives kept their wealth. And the culture that told a generation of traders that bending rules is just how the game is played, that culture didn't get a fine. It didn't get a courtroom. It got a memo. Tom Hayes once said something in one of his recorded interviews that stayed with me. He said, "I was a good trader in a corrupt system. Whether you believe him or not, the system part is undeniable. LIBOR didn't get rigged because one man was greedy. It got rigged because the entire architecture of global finance trusted gentlemen to police themselves. And gentlemen, it turns out, have a price. That price was $350 trillion. And the bill was paid by everyone who never knew the game was rigged. If you thought LIBOR was a brazen manipulation of the global financial system, wait until you hear about the traders who cornered the silver market and nearly broke the United States economy. That story's next. And that's how one rigged number broke the world's trust in banking forever.